Welcome to It's the Economy. The United States slashed its tariffs on China from 145% to 30% at its weekend talks in Switzerland, leading to, as we have been seeing, a 3 to 4% rally in US stocks and, of course, in equities globally, India included. But US yields rose 10 basis points yesterday to 4.45%, the highest in a month. So do these stocks completely alter the global growth picture, the recession picture in the US, interest rate picture? Joining me to discuss the impact of the US-China deal on the United States and the global economy is Andrew Tilton, Chief Asia Pacific Economist at Goldman Sachs. Andrew, good morning and thank you very much for your time. Well, 2 trade deals have been signed, one with America's biggest trade adversary, China. Are you changing your growth forecast for any country now?
Yes, we are. Our U.S. economics team has upgraded their growth forecast from 0.5% over the next 4 quarters to 1% and lowered their probability of recession in the U.S. from 45% to 35% on the back of the U.S.-China trade announcement yesterday. I think it's fair to say this was better than expected, more dovish than expected by most, if not all, observers going into the weekend.
Are you saying, 30% tariff is lower than the threatened 145, or is it lower than even what you thought it will come to after the talks?
Yes, we had expected it to come down. There had been more friendly talk last week, including messages from the U.S. administration, but we had thought perhaps we'd settle somewhere in the 50% range for U.S. tariffs on China. In the end, the temporary, I should emphasize, temporary agreement is, for 90 days at least, is a reduction to a 30% increase this year relative to where we came into the year, a 30 percentage point increase, so coming down from triple-digit levels. Nonetheless, that was better than expected, and China to lower its increase to 10%, as well as remove some non-tariff barriers. So from that perspective, it was better than we had anticipated. I think it was better than almost any market observer had expected going into the weekend. We had already upgraded slightly our China export forecast last week, given a little bit more momentum, heading into the tariffs, and also signs that export competitiveness for China remains very strong outside the U.S. In addition to that, we've changed our view, late last week on the renminbi. We think it can now appreciate gradually versus the dollar, again, on the back of a weaker broad U.S. dollar and a slightly better export outlook. If anything, the weekend's agreement, poses further upside risk to that.
The renminbi is appreciated all right, but look at the DXY. The DXY has actually jumped up as well from 99 to 101.5 right now, even as we speak. So what should we expect from the dollar and therefore from other Asian currencies like rupee?
I think some bounce in the dollar is not too surprising given how bearish sentiment had shifted and how far the dollar had moved this year. So speculative positioning was very short the U.S. dollar. Sentiment was very negative on the U.S. dollar in the wake of tariff uncertainty. That said, that provided perhaps the basis, particularly on this, better than expected, so to speak, deal. That provided the basis for a bounce in the dollar, which I think is what we're seeing. Over the medium term, we would still expect at least a little dollar depreciation. The dollar remains significantly overvalued on our long-term currency valuation metrics, around 15% or more, 15% or more over the longer-term valuation metrics. So we still think the longer-term trend is for dollar depreciation. Irrespective of that, if we just look at China versus the U.S., we think there is some room, perhaps informally as part of this deal to, avoid further depreciation against the dollar, though I would emphasize nothing was said publicly about currency being part of this deal.
No, I agree. I got that doubt as well. I mean, the Chinese currency at 7.18 today is actually the sharpest it has been. It's the strongest since November 10th. So we have to watch out the renminbi. There's some appreciation there. Okay, let me come to growth forecasts. Are there any change in Asian growth forecast? You said US you have upped. Goldman Sachs had cut GDP forecast for almost all Asian countries post that April 2nd deal. But now the trade deals are being signed. Are you increasing our growth forecasts?
We haven't made changes to other Asian forecasts at this time, although I think it's fair to say there's some upside risk to our 4% forecast of China growth. But I also think would note that we never assumed the full reciprocal tariffs would be implemented. We had discounted that somewhat back following the April 2nd announcement, and it still seems as if we will get average tariff levels above 10%. There'll be a 10% tariff, it appears, for pretty much all countries outside North America. And then on top of that, the so-called critical goods tariffs, which so far have been 25% in a number of sectors. So the weighted average of those things varies by country depending on what proportion of their exports are critical goods, but would be somewhat above 10%. So from that perspective, ex-China, the tariff picture for the rest of Asia doesn't appear to have changed too much. On the margin, the news is a bit more positive from a growth and markets perspective, but no new news really for the rest of Asia.
No new news, but the trend appears to be more benign than the April 2nd announcements. What are your forecasts for India? In our case, there is a border tension too that you may want to, discount.
Well, clearly there's risk of short-term economic impacts, hopefully short-term, from the recent disruptions. Nothing, in our view, has changed in terms of the medium to long-term forecast for the Indian economy. We've seen, meaningful policy tightening over the last couple of years in the form of lower fiscal deficits, until recently, a steady policy interest rate and some, credit regulation tightening a while back. Now we appear to be moving into a period where policy is more neutral or even more supportive for growth, with rates starting to come down. So from that perspective, we do think sequential growth in the Indian economy could pick up later this year and headed into 2026.
Okay, good to hear, 7%. Well, what are your recession fears in the United States? And hence, have you altered your expectations from the Fed? I just want to point out that US bonds rose very sharply yesterday after the China deal.
Absolutely. Markets have pushed back, expectations for Fed easing in light of what appears to be a better growth outlook, and so have we. We've, first of all, lowered our estimate of recession probability to 35% over the coming year from 45% previously. So still significant recession risk, but again, not the base case. And then on the Fed, we'd previously seen a few cuts in the second half of the year, but we've pushed those back to start in December. So we continue to see 75 basis points of what you might call insurance cuts starting in December and occurring every other meeting. There's not as much near-term pressure to cut policy rates as it appeared. And given that inflation is still meaningfully above the Fed's target and likely will rise further, given that some tariffs are being imposed, we would not expect Fed cuts over the next few months.
Oh, your rate cuts start only in December, is it? Well, let's see. Let me come to the underlying medium-term fear that dominates Asian currency traders, and we don't speak about it much. Do you think there is actually a chance of a 100-year treasury being forced on Asian countries like India, or even a restructuring of the existing treasuries they hold? When the Taiwan dollar rose 10% last week, there were these fears. So do you expect sustained Asian currency appreciation?
Well, we've had a lot of questions about the potential other dimensions of the trade talks. Would they include discussions on currencies or, as you mentioned, potential agreements to buy U.S. assets? We haven't seen hard evidence of those kinds of arrangements. But going into all this, it's important to note the dollar was very strong for a number of years. We've really had, frankly, more than a decade-long cycle of during which generally the dollar has been appreciating, and as I mentioned previously, is overvalued on a lot of long-term currency valuation metrics. And so that created incentives over that period of time for, say, exporters across Asia, including in Taiwan, as you mentioned, to accumulate dollars rather than repatriate those foreign currency earnings. They often kept them in dollars, which were yielding pretty high yields.
Yes.
And we're seeing dollar appreciation. Now that trend may have turned, their incentives have changed, with the possibility of rates, at least it looked like the possibility of rates going lower and the dollar weakening. You've started to see some repatriation of those funds, which probably was part of the story about the strong Taiwan dollar and very sharp Taiwan dollar appreciation that we saw recently.
Okay, but currencies actually are an under-discussed topic here. We'll come back to it later. We are, let me come to the economy picture. We were expecting supply chains to be redrawn. And, this China +1 wave to bring more investments to India because of all this 145%. Now with the rates going down, does this lessen? Because, US and China appear to have smoked the peace pipe.
The immediate pressure for those kind of moves may ebb a little, but the larger picture is still, as you put it, that supply chains are being rethought, that there still are meaningful tariffs going into place. I'd emphasize, even if we stay at these levels, these temporarily agreed levels, this would still be the largest U.S. tariff increase in a century. That we'd still be raising the effective U.S. tariff rate by nearly 15 percentage points from where we started the year. So this is still a very big tariff increase. We've clearly seen an increase in geopolitical uncertainties. And so I think directionally, we're still very much in the world you described, where there will be a rethinking of supply chains. There will be a desire for larger firms to have potentially multiple sources of production in the event of future changes. And so I don't know that we're going to rewind this. I think still directionally we're headed towards probably greater diversification.
Oh, that's actually good for us. Well, just the last question on global GDP forecasts of Goldman Sachs. Have you all changed that lately because trade deals are getting signed quickly?
The key global change has really been the upgrade in the U.S. forecast. So that's the half-point increase from 0.5% to 1% on the U.S. economy, where we had been quite cautious. Collectively, we haven't made other changes at this time. So the U.S. was the place imposing the highest tariffs. Collectively, the biggest impacts are really felt on the U.S. itself.
Yes.
And that's really where we've made the change so far.
Okay, yeah, and the mother economy always emanates growth pressures for the others. So we'll take that with both hands. Thank you very much, Andrew Tilton, for joining us in what perhaps was a busy day for you with all these markets up and about. The Indian GDP forecast is what we should take home. 6.3 unchanged for the current year, but 6.5 next year and 7% going into the medium term is the Goldman Sachs forecast. On that positive note, wrap up on Bazaar chart process coming up after a break.